As we look at the screens right now on this Thursday, December 18, 2025, FuelCell Energy Inc. is trading at 10.14 USD, which puts it up a massive 28.35% for the day. That is an intraday jump of 2.24 USD. And if you've been watching the ticker symbols across your favorite investing sites or your individual brokerage account, you know this kind of movement usually signals something much bigger than just a retail-driven pump. While most people see a move like this and assume it is just another speculative run in the clean energy space, the actual story here is much more grounded in a specific shift that many ignored until this morning. The expectation among most traders was that this company would continue to struggle with high operating costs and a slow path to profitability. The reality, however, is that FuelCell Energy just confirmed a strategic alignment with the biggest growth engine in the current market: AI-driven data centers. While everyone has been obsessing over Nvidia stock or trying to find the next big thing in Apple stock, the physical infrastructure required to keep those technologies running is hitting a wall. Data centers need massive amounts of reliable, around-the-clock power, and the traditional grid simply cannot keep up. That is where the surprise comes in for FuelCell Energy. By positioning their fuel cell solutions as the answer to the grid capacity limitations, they have essentially attached themselves to the AI infrastructure trade. This morning's surge is a direct reaction to their fourth quarter fiscal 2025 results, which showed a significant revenue beat and, perhaps more importantly, a backlog that has grown to 1.19 billion USD. When you see that kind of forward-looking demand, it changes the conversation from will they survive to how fast can they scale. If you're using tools like Schwab Intelligent Portfolios or managing your own trades through SoFi Active Investing, you've probably noticed that the clean energy sector has been a volatile place to park capital lately. Many investors have been burned by the hype of the past, leading to a general belief that hydrogen and fuel cell technology are just black holes for cash. But if we look at the actual numbers reported today, the gap between that negative sentiment and the fiscal reality is starting to close. Total revenue for the quarter hit 55 million USD, which is a 12% increase year over year. For the full fiscal year of 2025, revenue is up 41% to 158.2 million USD. This is not the profile of a stagnant company. They're actually narrowing their losses, with a net loss per share of 0.85 USD compared to the 2.21 USD loss they posted in the same quarter last year. Institutional activity has also been picking up steam in a way that suggests the big players are seeing value where the retail crowd was hesitant. We saw a fresh round of debt financing from the Export-Import Bank of the United States, specifically for their projects in South Korea. This kind of government-backed support provides a layer of security that you rarely find in the small-cap clean energy world. When you're looking at your Fidelity brokerage or checking your positions on the Robinhood app, it's easy to get caught up in the daily price swings of something like Tesla stock, but the underlying institutional support for FuelCell Energy suggests a longer-term conviction in the necessity of their technology for grid resiliency. They're not just selling a product, they're selling a solution to a global energy crisis that is only getting more intense as our digital demands grow. Let's talk about the business model for a second, because it is often misunderstood. Most people think fuel cells are just batteries, but that is not the case at all. They are power plants. They take fuel, often natural gas or hydrogen, and convert it into electricity through an electrochemical process that is much cleaner and more efficient than burning it. They also have a unique ability to capture carbon during that process. This makes them incredibly attractive to large-scale industrial users and, as we have seen recently, data center operators. While companies like Fidelity Wealth Management or Interactive Brokers often point clients towards diversified Fidelity ETFs or Fidelity mutual funds for stability, those looking for high alpha opportunities often find themselves examining these specific infrastructure plays. FuelCell Energy is focused on distributed power generation, which means they put the power source right where the demand is, bypassing the aging and overloaded national grid. The company's facility in Connecticut is a major piece of this puzzle. They have the capacity to scale their production to 350 megawatts per year with the right investments, and they are currently operating at a rate that is moving them closer to that crucial positive adjusted EBITDA milestone. Management has been very clear that reaching the 100 megawatt production level is the target that changes the financial profile of the entire organization. For those of you who use the Robinhood trading platform or the Fidelity mobile app to execute trades, this is the metric you need to be watching in the coming quarters. It's the bridge between being a high-growth speculative play and becoming a fundamentally sound, profitable energy provider. When we look at the macroeconomic pressures, it's clear that the shift towards decarbonization is no longer just a political point, it's an economic necessity. Companies are being forced to find ways to reduce their footprint while increasing their output. This creates a tension that FuelCell Energy is uniquely suited to resolve. On one hand, you have the expectation that green energy is too expensive or too difficult to implement at scale. On the other hand, you have the reality of companies like Microsoft, Google, and Amazon needing massive amounts of clean power to meet their climate goals while running their AI models. If you're doing your online investing through interactive brokers or a professional-grade platform, you know that the picks and shovels of the AI world are no longer just chips, they're the electrons that power the chips. The recent 1-for-30 reverse stock split that happened earlier in the year was a move designed to maintain compliance and attract more institutional eyes, and it seems to be working. While reverse splits often carry a negative stigma, in this case, it cleared the way for the stock to be taken seriously by the larger funds that populate the holdings of your Fidelity IRAs or Schwab Intelligent Portfolios. The trading volume we're seeing today is significantly higher than the daily average, which tells us that big blocks of shares are changing hands. This isn't just retail enthusiasm on the Robinhood app, it's a fundamental reevaluation of the company's worth in a market that is hungry for infrastructure solutions. I want to pause here for a second and get your take on this. Comment below how many shares of FuelCell Energy you currently hold, or let me know if you're looking at other hydrogen plays like Bloom Energy instead. It's always interesting to see how the community is positioning itself during these massive volatility events. Continuing with the analysis, the geographic diversification is another area where reality is exceeding the common market narrative. While much of the focus is on the U.S. grid, FuelCell Energy has a massive footprint in South Korea. They have over 100 megawatts in their current backlog there and are pursuing even more through partnerships with companies like Korea Hydro and Nuclear Power. This international revenue stream provides a hedge against U.S. policy shifts and demonstrates that their technology is competitive on a global stage. When you're looking for investment help or researching investing sites to understand where the growth is, you have to look beyond the domestic headlines. The fact that they can successfully navigate the complex energy markets of Asia speaks volumes about the maturity of their platform. Comparing this to the movement of other big names in the market, like the recent volatility in Nvidia stock or the steady climb of Apple stock, FuelCell Energy offers a different kind of risk-reward profile. It's a high beta play, meaning it moves much more than the broader market, which is why it's so popular for active trading on the SoFi trading platform or with interactive brokers fees that favor high-frequency movers. However, unlike many other small-cap tech or energy stocks, FuelCell Energy actually has a massive tangible backlog. They're not just selling a dream, they're fulfilling contracts. The $1.19 billion backlog provides a level of revenue visibility that is rare for a company at this stage of its recovery. When we look towards the future, the catalysts are lining up in a way that could sustain this momentum. Beyond the data center focus, the potential for carbon capture technology to be integrated into existing gas-fired power plants is a massive untapped market. The expectation is that carbon capture is decades away from being commercially viable. The reality is that FuelCell Energy is already running pilot programs with some of the largest energy companies in the world, including ExxonMobil. If those pilots move into full-scale commercialization, the valuation models for this stock would need to be completely rewritten. Of course, we have to talk about the risks. The path to positive cash flow is still a work in progress, and the company has historically relied on share issuances to fund its operations. While they ended the quarter with a solid cash position of nearly $342 million, including restricted cash, investors must stay vigilant about future dilution. This is why many people choose to use a robo-advisor like the SoFi Robo-Advisor or Schwab Intelligent Portfolios to manage the risk of individual stock picking. Self-investing requires a deep understanding of these balance sheet mechanics. If the company fails to reach that 100-megawatt production target, or if the data center demand shifts to a different technology, the stock could easily give back these gains. But today, the narrative is firmly in the bull's favor. The narrowing of operating expenses, which fell by about 30% this quarter, shows that management is finally getting a handle on the costs that have plagued the company for years. They're becoming a leaner, more focused organization that is prioritizing commercially viable projects over speculative research. This shift in strategy